What if I told you the stock market has been quietly rewarding investors while most people weren't even paying attention? Today, we're breaking down why November looks so promising for stocks, and why, despite all the good news, experts say a little caution goes a long way. Here's what you're about to learn: what's driving this market rally, what it could mean for your portfolio, and why "stay the course" is the mantra on Wall Street right now. So let's get into it, because the numbers don't lie. The S&P 500 just wrapped up October with a solid rebound, bouncing back from a rough September. For context, the stock market typically struggles in September, but November and December, historically, those are two of the strongest months for investors. In fact, data from LPL Financial shows that since 1950, the S&P 500 has gained an average of 1.5% in November. That's not pocket change if you're in for the long haul. But here's where it gets interesting. This rally isn't just about seasonal trends. Investors are feeling more optimistic as inflation starts to cool and the Federal Reserve hints it might pause on interest rate hikes. Lower inflation means your dollars go further, and stable rates make borrowing less expensive for companies and consumers alike. That's a recipe for growth. Still, there's a twist. Even with these tailwinds, there's some nervousness under the surface. Geopolitical tensions, lingering recession fears, and sticky inflation haven't gone away. That's why the experts aren't popping champagne just yet. Instead, they're saying, enjoy the gains, but don't get greedy. It's like finding extra fries at the bottom of your bag. Sure, celebrate, but don't assume it'll happen every time. Let's zoom out for a second. Remember, the bull market since the COVID crash in 2020 has given investors a wild ride. We saw huge gains, then 2022 brought volatility, and now in late 2023, the market is grinding higher again. It's a reminder, the market rewards patience, but it tests your nerves. Here's another angle. Retail investors, meaning everyday folks, have been pouring back into stocks after sitting on the sidelines earlier this year. That's often a sign that confidence is returning. But, and it's a big but, when everyone rushes in at once, markets can get overheated. That's what no one tells you about risk. Sometimes the crowd gets it wrong. So, what should you actually do with all this? Most financial pros recommend sticking to your plan. Diversify your investments. Resist the urge to chase the latest hot stock, and keep your emotions in check. History shows that those who stay invested through ups and downs generally come out ahead. But don't just take my word for it. Look at Warren Buffett, arguably the most successful investor in history. His strategy? Buy great companies, hold them for the long term, and tune out the daily noise. Simple, but not always easy. So, as we head into November, there's a lot to be thankful for if you're invested in the market. But remember, the best investors are always cautiously optimistic, never blindly hopeful. If you found this breakdown helpful, hit like, drop a comment with your market questions, and subscribe for more clear, no-nonsense investing updates. And as you watch the markets this month, ask yourself, what's more important, short-term gains or long-term discipline? The answer might just shape your financial future.